90%. That is the share of Indonesia's ride-hailing and food delivery market that would be controlled by a single entity if Grab and GoTo merge. Two companies, 200 million users, one market that covers everything from motorcycle taxis to digital payments to e-commerce. And this deal, the largest proposed tech merger in Southeast Asian history, has been stuck for months because of a 2% stake held by a state-backed telecom company. This is a story about monopoly power, national pride, and whether Southeast Asia's startup era is about to end in consolidation.
Set the scene for me, because I know Grab and GoTo individually, but I want to understand the full picture of what this merger actually means.
Let's start with where both companies are right now, because the financial picture has changed dramatically. Grab, the Singapore-based super app, just posted its first full-year net profit in 2025. Revenue hit $3.37 billion, up 20% year-over-year. The company turned a $200 million profit after years of massive losses. For context, Grab lost billions of dollars between 2021 and 2024. The turnaround has been remarkable. Q4 2025 alone generated $906 million in revenue, with adjusted EBITDA growing 54% year-over-year to $148 million.
And their 2026 guidance?
Revenue is expected to grow another 20 to 22%, reaching $4 to $4.1 billion, with adjusted EBITDA projected between $700 and $720 million. Grab is no longer a money-losing startup. It is a profitable, growing, publicly listed company trading on NASDAQ.
What about GoTo? Because they've had a very different trajectory.
GoTo, which is the 2021 merger of Gojek and Tokopedia, has been through a rougher path. Full year 2025 revenue was IDR 18.3 trillion, up 24% year-over-year, and losses narrowed by 77% compared to 2024. They posted their first pre-tax profit of IDR 62 billion in Q3 2025. So GoTo is also moving towards profitability, but it is further behind Grab.
And then there's the Tokopedia situation.
Right. This is a critical piece of the puzzle. In December 2023, GoTo sold 75% of Tokopedia, its e-commerce arm, to TikTok's parent company ByteDance for $840 million. GoTo retained a 25% stake. TikTok essentially took over Tokopedia's e-commerce operations, merged them with TikTok Shop, and created the dominant social commerce platform in Indonesia. By 2025, TikTok Shop plus Tokopedia had estimated GMV of around $20 billion, with live commerce growing from 5% to 20% of total transactions.
So GoTo gave up its e-commerce business, but kept its ride-hailing, food delivery, and fintech arms.
Exactly. And that makes GoTo a much more focused company. On-demand services contributed IDR 12.36 trillion, or about 67% of total revenue. The fintech arm, GoPay, is the fast-growing piece that multiple analysts believe is the most valuable asset in the entire GoTo portfolio. GoTo is essentially a ride-hailing and fintech company now, which is precisely the profile that makes a Grab merger both attractive and deeply controversial.
When did the merger talks actually begin?
The talks have been circulating since late 2024, but they became serious in late 2025. Bloomberg reported in January 2026 that Grab was pursuing a takeover, not a merger of equals, but an acquisition of GoTo. The combined entity would dominate ride-hailing, food delivery, and digital payments across Southeast Asia, with particularly overwhelming market share in Indonesia. And that is where the problems began.
So what's actually blocking the deal? You mentioned a 2% stake?
The immediate obstacle is Telkomsel, Indonesia's largest mobile operator, which is majority owned by the state-controlled PT Telkom Indonesia. Telkomsel holds roughly a 2% stake in GoTo, which it acquired in 2020 at a significantly higher valuation than GoTo's current market price. Bloomberg reported in January 2026 that Telkomsel is unwilling to sell at anywhere near current valuations because doing so would crystallize a loss on state capital. And under Indonesian law, losses on state-owned capital can have legal consequences for the officials who approve the investment.
Wait, so the government-linked investor literally cannot afford to sell at a loss because it could be treated as a legal violation?
That is the situation. It is not just a financial negotiation. It is a legal and political trap. If Telkomsel sells its GoTo stake at current prices, someone within the Telkomsel and Telkom Indonesia chain of command could theoretically face legal scrutiny for mismanaging state assets. This is a very Indonesian problem. The intersection of state ownership, corporate governance, and legal liability creates paralysis. Telkomsel is trying to negotiate a higher price for its stake as part of the deal structure, but Grab has limited incentive to overpay for a 2% position.
And then there is the Danantara angle.
This is where it gets really interesting. Danantara, Indonesia's new sovereign wealth fund created in February 2025 under President Prabowo Subianto, has indirect exposure to GoTo through Telkomsel and Telkom Indonesia. Bloomberg published a feature in mid-March calling Danantara's first year turbulent.
The fund manages approximately $900 billion to $1 trillion in assets, and Prabowo has instructed it to deliver at least a 5% annual return, roughly $50 billion, back to the government, with a target of 10 to 15% annual returns.
$50 billion a year in returns? That is an ambitious target for a one-year-old fund.
Very ambitious, and it creates a specific incentive structure around the GoTo deal. If Danantara facilitates a Grab-GoTo merger in a way that protects the value of Telkomsel's stake, it can claim a win. If the merger falls apart or Telkomsel takes a loss, it becomes a political liability for the fund. Deal Street Asia reported that Danantara is actively participating in the regulatory drafting process around the merger. This is not a neutral observer. It is a stakeholder with competing pressures.
What about the antitrust side? Because 90% market share sounds like an obvious red flag.
Indonesia's Competition Commission, known as KPPU, has publicly warned that any Grab-GoTo merger must not create a ride-hailing monopoly. The combined entity would control approximately 90% of ride-hailing and food delivery in Indonesia, which is an extraordinary level of market concentration by any standard. KPPU has signaled that it would require significant conditions, potentially including price caps, driver protections, or asset divestitures, before approving any deal.
And there are political concerns beyond antitrust.
Multiple layers. First, there is the national champion argument. GoTo is one of Indonesia's few homegrown tech success stories. It grew out of Gojek, which started as a motorcycle taxi booking service in Jakarta. Selling it to Singapore-based Grab triggers deep sensitivities about foreign ownership of national assets. South China Morning Post published an analysis titled Grab's GoTo takeover bid, a step too far for Indonesia, that captures this sentiment. Second, Indonesian politicians have raised concerns about potential fare increases for consumers and job losses for drivers. Third, there is a broader question about whether Indonesia's digital economy should be controlled by a Singapore-headquartered company, even one that operates primarily in Indonesia.
How does Grab's geographic revenue breakdown factor into this?
This is a detail that a lot of people miss. Grab's 2025 revenue by country shows Malaysia as its largest market at $1.04 billion, the only market exceeding $1 billion. Singapore generated $727 million, and Indonesia was third at $715 million. So Indonesia is actually Grab's third largest market by revenue, not its first. If Grab acquires GoTo, Indonesia would immediately become the dominant market for the combined entity by a massive margin. The power dynamic shifts, from Grab being a Singapore company with a strong Indonesia presence to Grab being an Indonesia-centric company headquartered in Singapore.
That reframe matters a lot for the political optics.
It does, and it's something Grab's management understands. Bloomberg reported that Grab wants to ensure all stakeholders in Indonesia support the takeover proposal because the deal requires government approval. Grab cannot force this through. It needs buy-in from Danantara, from Telkomsel, from KPPU, and from the political establishment. That is a lot of stakeholders with different and sometimes contradictory interests.
Contrarian corner. The consensus view seems to be that this merger is inevitable, that Grab and GoTo will eventually combine, because the economics of competing head-to-head in Southeast Asia's ride-hailing market are unsustainable. What is the skeptical read?
The contrarian position is that this merger should not happen, and that the market would actually be better served by continued competition. Here is why. Both Grab and GoTo just achieved or approached profitability for the first time in 2025. Grab posted a $200 million profit. GoTo posted its first pre-tax profit in Q3 2025. The argument for years was that these companies needed to merge because neither could be profitable alone. That thesis has been disproven by the 2025 results.
So if both companies can make money independently, the urgency for the merger disappears.
Exactly. The profitability milestone actually undermines the merger thesis. When both companies were burning cash at unsustainable rates, consolidation made strategic sense. Eliminate redundant spending, rationalize driver incentives, reduce competitive pricing pressure. But now that both have demonstrated they can operate profitably as independent companies, the question becomes, who benefits from the merger? And the answer is primarily the shareholders and management, not necessarily the consumers, drivers, or the Indonesian economy.
The drivers are an important constituency here.
They are the most important constituency, and the one least represented in the boardroom discussions. There are millions of Gojek and Grab drivers in Indonesia. Under competition, both platforms have incentive to offer drivers reasonable commission rates to prevent them from switching to the competitor. Under a monopoly with 90% market share, that incentive disappears. The platform can increase its take rate, the percentage of each fare it keeps, and drivers have no alternative. This is the classic monopoly pricing argument, and it applies to both the driver side and the consumer side of the marketplace.
KPPU has raised this concern, but do antitrust regulators in Southeast Asia actually have the power to block a deal like this?
That is the right question, and the honest answer is uncertain. KPPU has signaled concerns, but has not established a strong track record of blocking major technology mergers. Indonesia's competition law framework is still developing. The TikTok-Tokopedia deal went through, despite raising similar concentration concerns in e-commerce. However, the political dynamics are different here. The GoTo Grab merger is far more visible to ordinary Indonesians. Everyone uses ride-hailing. Everyone orders food delivery. A merger that leads to higher prices or worse driver conditions would be politically explosive.
What about the fintech angle? Because you mentioned GoPay is potentially the most valuable part of GoTo.
This is where the analysis gets really interesting. GoPay, GoTo's digital payments arm, processes transactions for millions of Indonesian small businesses and consumers. It has a banking license. It is growing faster than Grab's ride-hailing business. If Grab acquires GoTo, it gets GoPay, which would make the combined entity one of the largest digital financial services platforms in Southeast Asia. For Grab, which has been aggressively building its own financial services division, this is potentially transformative. Grab's financial services revenue in 2025 was $347 million and growing. Adding GoPay would roughly double that footprint in Indonesia specifically.
But doesn't that create additional regulatory complexity? Because now you're not just combining ride-hailing platforms, you're combining financial services licenses.
And that is a whole separate regulatory track. Indonesia's financial services regulator, OJK, would need to approve the combination of payment and lending licenses. Bank Indonesia, the central bank, has jurisdiction over payment system regulation. You're looking at approvals needed from KPPU for competition, OJK for financial services, Bank Indonesia for payments, and potentially the Ministry of Communication and Information Technology for data. Each regulator has different concerns and different timelines.
So the deal requires navigating at least 4 regulatory bodies simultaneously.
Plus the political layer with Danantara and the broader Prabowo government. Here is the contrarian scenario that I think is most underappreciated. GoTo does not merge with Grab at all. Instead, GoTo continues its current trajectory. Ride-hailing and GoPay become the core business. The TikTok-Tokopedia partnership provides e-commerce exposure through the retained 25% stake, and GoTo reaches sustainable profitability as an independent Indonesian company. In that scenario, GoTo becomes the national champion that Indonesian politicians want it to be, without the foreign ownership controversy. GoTo's 2026 EBITDA guidance of 3.2 to 3.4 trillion rupiah suggests management believes this path is viable.
So GoTo's management might actually prefer independence if they can achieve profitability on their own terms.
And Grab's management might prefer acquisition if they believe their own organic growth in Indonesia is reaching a ceiling. Grab's Indonesia revenue was $715 million in 2025, respectable but well behind Malaysia and only marginally ahead of Singapore. Acquiring GoTo would be transformative for Grab's Indonesia position, but the price of that transformation is navigating the most complex regulatory and political environment in Southeast Asia. The question is whether the juice is worth the squeeze.
Action items. What should investors and operators track here?
3 action items. First, track the Telkomsel stake resolution as the gating item for the entire deal. Bloomberg reported that a separate structure for acquiring Telkomsel's stake is being discussed, potentially involving a side agreement that protects Telkomsel from booking a loss on stake capital. This could take the form of a guaranteed price floor, a deferred payment structure, or an arrangement where Danantara absorbs the stake at a face-saving valuation. If Telkomsel's issue gets resolved, the deal moves forward to the regulatory phase. If it remains unresolved through mid-2026, the merger is effectively dead for this cycle. Watch for any announcements from Telkom Indonesia's quarterly earnings or from Danantara's investment committee regarding the GoTo position.
The second action item?
Watch KPPU's formal review process and what conditions it attaches if the deal reaches the antitrust stage. The 90% market share number means KPPU cannot wave this through without conditions. The types of conditions matter enormously for the economics of the deal. If KPPU requires price caps on ride-hailing fares, effectively limiting what the combined entity can charge, that directly constrains the revenue upside that justifies the acquisition premium. If KPPU requires driver commission floors, minimum payouts to drivers, that constrains margin expansion. If KPPU requires divestiture of GoPay or other financial services assets, that removes the most valuable synergy. The gap between a clean approval and heavily conditioned approval is the difference between a deal that creates value and a deal that destroys it. MLEX reported that Indonesia has signaled openness to the merger, but the details of conditional approval are everything.
Third,
track GoTo's standalone performance as the counterfactual to the merger. GoTo's 2026 EBITDA guidance of IDR 3.2 to 3.4 trillion is an important benchmark. If GoTo hits or exceeds that guidance, it demonstrates that the company is viable as an independent entity, which strengthens the hand of politicians and regulators who want to keep GoTo as an Indonesian national champion. If GoTo misses guidance or reverts to losses, the economic argument for Grab's rescue acquisition becomes more compelling. The counterfactual, what happens if the merger does not happen, is as important as the merger terms themselves. Investors should track GoTo's quarterly results through 2026 as a probability indicator for whether the deal ultimately closes.
The three signals are the Telkomsel stake as the immediate blocker, KPPU conditions as the deal economic determinant, and GoTo's standalone performance as the counterfactual that either strengthens or weakens the merger argument.
And all three interact. If GoTo's performance weakens, KPPU may be more lenient because preserving the company becomes a priority. If GoTo performs strongly, KPPU can impose tougher conditions because GoTo's independence is viable. Danantara's incentive shifts depending on whether it thinks a merged entity or an independent GoTo generates better returns for the state's indirect ownership position. These are not independent variables. They form a system, and understanding the system dynamics is how you stay ahead of the headline-driven analysis.
The big picture takeaway for me is that this is not really a merger story. It is a story about Indonesia's digital sovereignty. Whether GoTo remains independent or gets absorbed by Grab is a proxy question for whether Indonesia's tech sector is going to be controlled by domestic or foreign capital.
That is the right frame, and Indonesia is not alone in wrestling with this question. India has been through a similar debate with Walmart's acquisition of Flipkart. China went through it with the government's crackdown on tech giants to reinstate state control. Southeast Asia is arriving at the same crossroads a few years later, and the Grab-GoTo decision will set a precedent for how the region handles tech consolidation going forward.
And if you want the full written breakdown with the financial comparisons, the Danantara analysis, and the regulatory roadmap, it is in today's newsletter at asiatechmacro.substack.com.
In our next episode, we are examining the AI inference cost collapse, specifically how the dramatic decline in inference costs over the past 6 months is reshaping the economics of AI deployment across Asia, which companies benefit most from cheap inference versus expensive training, and whether the inference cost curve is the most important chart in technology right now.
That sounds like a topic that connects a lot of the themes we've been covering.
Stay data-driven. Bye.